Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. So let's just start with the news that the Pfizer vaccine will be rolled out across the UK. I mean, I got a message from somebody on the day that the news was actually announced to say, I'm guessing that the markets will take off like a rocket today, given that news. And actually, they didn't. What happened is, after the news, it was really a bit of a damp squib. Nothing really happened at all. Markets initially were flat to slightly down. Now, it suggests that a lot of the good news surrounding the vaccine for the COVID-19 virus has already been priced into markets. If you go back and grab your stock app on your smartphone and have a look at the market movements since the 9th of November, when the first news about the Pfizer vaccine broke, you'll see there was a big spike in the days that followed. And while the market has indeed continued to push higher, the rate of it has been much slower. And that's because obviously markets are waiting to see what actually happens and when the vaccine will arrive and how it will be taken up by the general population, because that's obviously still one of the issues, how many people will take the vaccine. And of course, that means that while markets have been pushing higher, there has been this element of doubt that's crept in. And so what we're seeing now is markets rather flat, looking for another sense of direction. Will it be the Santa rally going into December? That sort of seasonal trend we see most years help to push the markets that little bit higher. But as I said, we didn't see the market take off. Yes, the FTSE finished up on the day, but a lot of that was around optimism surrounding the Brexit talks. They're still ongoing. We seem to talk about this every week, but there's hope that we should see a light at the end of the tunnel in the next couple of days. And in fact, that's been reflected in the volatility of the pound. The pound is still pushing higher towards $1.34. And we've seen it pull back and rise. A lot of volatility based around the news surrounding those particular talks. So that is going to have a big impact on portfolios in the next couple of days for UK investors. If we get a Brexit deal, then perhaps a lot of the good news has been priced in already. We could see a spike higher on the pound versus the dollar. But equally, if it's bad news and there is no agreement, we could see the pound fall against other currencies globally. And that would have an impact. That would actually be a boost for your overseas holdings when you talk about the currency exchange rates. But after the vaccine news, we saw a little bit of profit taking around the world. We saw equity markets be a bit soft on the day. Some of them were down flat or just a little bit down, particularly in Europe and the US. So, I mean, don't get me wrong. We finished November and we saw some all-time highs in the US, in Germany. We saw almost a 30-year high in the Japanese stock market. The MSCI World Index hit an all-time high. We saw pretty much the best ever month for stock markets around the world. Pick your stock market and it was up around about 12%. And I mean, even the Nasdaq 100, which obviously had a bit of a wobble during the month because of the vaccine news, it still was up over 10%. So the good news surrounding a vaccine and the US election means that we are still in this very much aggressive uptrend. The same can't be said for government bonds, so they are obviously the safest form of debt. We've seen those sell off during the month. As we hit December now, we're seeing their yields still pushing higher. And interestingly, going forward, if yields on government debt continue to push higher, that is a bad omen for the tech stocks out there, the Nasdaq. That's because obviously if we have inflation and we have higher interest rates at some point, that isn't great for the Nasdaq. And that's because if you think about it, what actually happens is that for a lot of these big tech companies, their future earnings or their earnings, the big pot of money at the end of the rainbow is way off into the future. So when you discount that back with a higher interest rate, then the current share price doesn't look actually, well, the discount, so you get this current share price is actually lower. So it isn't good news is what you need to take on board for tech stocks necessarily, but we have to see what happens. So we are in this position now with markets still pushing higher, bit of profit taking going on. Perhaps it's not surprising then that we're seeing the fear and greed index. So CNN do a fear and greed index. It's a combination of 7 different indicators. It's meant to show whether greed or fear is driving the market. So think back to the beginning part of the year when everything was amazing before COVID hit. It's measured between sort of 0 and 100. We were pushing up to historic high levels. We're getting up to like 96, 97 on this index. Once the COVID virus hit, then obviously everyone went into panic, fear took over, and this index was pushing down into sort of lows that we hadn't seen for years as everybody panicked. Well, what we're seeing at the moment is that greed has risen to levels we hadn't seen since just before the pandemic hit. Now, if you go back historically, when greed is the overriding emotion in markets, it can precede a market sell-off. And so where we are at the moment, everything feels awesome, and it's certainly, there's a lot of optimism out there. But do be aware that at some point, I mean, the phrase is pride comes before fall. So we could at some point in the future be looking at a sell-off as emotions get carried away, investors' emotions get ahead of themselves. But if you look back towards sort of 2019 into 2020, that greed index can actually run quite high for a considerable period of time before we get a sell-off. So it doesn't mean it's going to happen imminently, something to be aware of, but could, as we go into 2021, we could see something like that. And of course, markets can't go up forever. We have to be mindful of that. Now, the other asset I want to talk about is gold. It's been quite interesting this week. You will have seen gold falling, almost feeling like through the floor. We broke through that $1,800 barrier. We went down to $1,750, which is a key support level. If you look at that and go back to earlier on this year, that was where markets really broke out from when they were pushing towards those highs that we saw during the summer. Now, 1750 held for gold, and we saw a bit of a bounce from there. Will it continue? Who knows? I mean, we've seen the slide in the dollar suddenly continue. And of course, that was always good news for gold and a lot of commodities. But what we're seeing now is gold behave differently in relation to the dollar than it did during the summer. So in the summer, whenever the dollar fell, gold did well, like most commodities. But we're seeing now that they move in lockstep in a positive correlation. So gold is going up when the dollar strengthens. I mean, it's an unusual pairing and an unusual correlation, but that's the world we're in at the moment. So at the moment, gold is underperforming, and part of that is down to the fact that it's based around a lot of inflation expectations. We were expecting the world to accelerate in terms of growth, but the inflation expectations weren't there. And of course, now we're starting to see some of that expectation of future inflation creep in, which is starting to have an impact, a positive impact on gold at the moment, but certainly for commodities more generally. So that's why you've seen a lot of commodities rally in recent weeks, especially in recent days. So going forward, it's something to keep an eye on as we move into 2021. Is inflation going to be the story that everybody's talking about? And of course, bonds don't like inflation, which is another reason why they have started to lag equities in particular in the last month or so. Now, shifting from gold to Bitcoin, I don't talk about Bitcoin all that often, but it's quite interesting because if you look at Bitcoin, people were talking about, as I mentioned previously, that gold and Bitcoin were being seen as almost interchangeable. Bitcoin is seen as the new gold when you're trying to place a particular bet on the direction of the dollar. Well, as the dollar keeps falling, Bitcoin is going through the roof. So we're seeing a new all-time high in that asset, which is quite interesting. After the 10% correction that we saw the previous week, it's going to continue to be a volatile asset. It'd be just interesting as investors to watch it, not necessarily to get involved in it, but to watch what is going on with those asset classes. But it just reflects the wider bullish optimism that's out there in investment markets and the increasing risk appetite that we're seeing heading into the end of 2020. So in the coming days and weeks, keep an eye on news surrounding stimulus from the Fed or the US government. Of course, news on the Brexit negotiations will all have a big impact on markets, probably in the next week, because they are running out of time. So a lot to keep an eye on. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien, at moneytothemasses.com is the email address. Twitter, money to the masses with the number 2. Of course, you can find us on Instagram and Facebook. And don't forget to subscribe to our YouTube channel.